Welcome back to Everything Money. As always, I'm your host, Seth. I'm back from vacation. Boy, did the show fall to pieces without me. I'm glad I'm back, and so are you. I'm here with Paul and Mo. We welcome you into our channel. The channel is about me, a normal guy, a wedding photographer, formerly wedding photographer, Paul. I'm kidding. I'm still a wedding photographer. I have weddings next year, but I'm a normal guy with a normal upbringing, asking your questions to a couple wealthy guys who own mansions all over the world. Paul, I love saying that because I get to visit them myself. But we bring your questions. And today we're talking about another stock that we love. Well, I don't know if Paul loves it, but I've always loved it. Paul, company. I know you love watching Netflix.
Oh, Netflix is great. I was in my immense sickness from the vaccine shot I got the other day. I watched the full first season of Entourage plus half the second season. Literally, I'm just like at night just going. And it's funny because I was watching it and there was a couple funny parts, like Ari Gold's talking to E, and E says something, and Ari goes, "Hey, the luckiest thing that ever happened to you was being born next door to Vinny Chase." And I laughed pretty hard about that one.
I had Netflix, a lot of Netflix, folks. One of my first stock tips from a normal person when I got my job when I was 30 was buy companies you love. Your mother has probably told you this. Your great uncle's probably told you, just buy stocks that you love and love using. That doesn't always work, and we'll show you why. But Paul, if you recall, I had a ton of Netflix. I had a ton of Amazon. I had a ton of Tesla. I loved Netflix. And damn, Paul, I must have bought it back when it was, I'm thinking like 2011 or 12. Wow. I mean, 11 some odd dollars. Paul, I sold on this show after a massive uptick, probably around 2018, but now look at it, Paul. It's just exploded, and we know why from last year. Everyone sits at home and watches this, but we have exciting news moving forward with Netflix about some video game streaming services. Netflix is disruptive, Paul. I don't know, but
I would consider it disruptive.
Remember when we had to get the first? Remember when we had to get the DVDs, Mo, in the mail?
And that was incredible. That was like, incredible. Oh my God, you can get these DVDs in the mail.
And it was fast too. They did a good job.
So I digress. Today we're going to talk about Netflix. Not so much the stock ticker price, but what's behind the ticker price. We're going to use, as always, our 8-pillar analysis to look at the fundamental financials of the company. And if this is new to you, it's a value investing approach. So we're basically going to say, can we buy this company? Is it cheap? Are we getting a deal on this? And if not, we're most likely going to avoid. But we'll take a look right now. I welcome in the seer of seers, the prognosticator's Paul Gabriel. Welcome in, Paul. And let's get after Netflix, my friend.
Netflix. So this is the chart from 2016. Man, that thing was $100 in 2016. That's incredible.
Look at that puppy.
$240 billion market cap, a PE of a healthy 65. So that's an X. Boy. Profit margin of 14.2%. That's a check. So the first reaction I'm going to get from people is, Paul, this is a growth stock. You don't get it. You don't like growth. I love growth, guys. Growth is an important part of our stock analyzer tool, which we'll show you in this video. Growth is the very first line of the analysis. Growth is one of the most important aspects of value investing, in my opinion. There are many different forms of value investing. For me, I like to buy established companies that have steady cash flow and steady growth. Now, the question is, do I want to overpay for growth? And that's where I sit there and say an emphatic no. And that's what the average person does when they do things like the lady at Seth's work who said, buy companies that you know and love. Imagine a world in which it was that simple to invest, where you just bought companies that you loved and that was it.
Yeah.
Right? So we'll get into the growth part of it. They don't pay a dividend, which I don't expect them to, because when companies are growing, they want to invest back in themselves, and they shouldn't pay a dividend when they have reasonable returns of investments within the company to help it grow. All right, so far 1X and 1 check, but the 1X is pretty important.
Pillar number 3 is revenue growth over the past 5 years.
What do you think this is?
Yeah, look at that.
9.5 to 26 billion. That's a check mark.
Of course.
It's tripled, almost tripled in revenue in the last 5 years. Net income.
Profit growth.
337 to 3.7. That's 11 times growth, which is expected with a high gross. What was their gross margin? Their gross margin was 41%. So that means every dollar that comes in, they're driving 41% of that profit into the bottom line. So in our stock analyzer tool, one thing I want you to notice is we don't talk about gross margin, but with companies with higher gross margin, if you have a high rate of revenue growth, you should have a higher profit margin overall if you foresee their cost structure to stay the same. Like, I don't know how Netflix would increase its costs on its overhead as it grows. It's probably pretty healthy as it is. You know what I mean? So that's something to consider going forward.
If you like these numbers behind Paul, you can get this software being a part of our Patreon. If you join our Patreon, the link is in the description below. You join our community of Paul, 30, almost 4,000.
We'll hit 4,000 today.
Oh my Lord in heaven!
When we started this thing last year, Seth came to me and said, "Paul, we need to do a Patreon." I said, "There's no way I'm doing a Patreon." He said, "Why not?" I said, "I'm not going to ask people for money. Just ask people for money." So then I said, "Well, what about this? We wanted to create the software. What if we do this as a way to get the software out?" Bam. My goal was to have 725 people by the end of 2021 who use the software. It is currently July 15th, and we have almost 4,000. This is the software right here. It is currently $25 a month, not 14.
Used to be 14. Used to be $8. Yes.
And it's gone up every single month compared to other companies that literally do the exact same thing we're doing. YCharts has really good customer service. 8 years, we actually have 30 years of financial data now, stock analyzer tool, real estate calculator, house flips, momentum trading, stock screeners, retirement calculator, exclusive content, guys, exclusive content. Our goal is to do 1 video a day for YouTube and 2 videos a day for our website, and the mobile app has come out. Yes. We already have 42 reviews, all 5 stars. Android is coming out today or tomorrow. Guys, this is incredible value play. It's 80 cents a day if you're serious about your investing. Just the content alone is worth 80 cents a day. This is insane not to do it. Sign up today.
Yep, join the Patreon, you get the software. Paul, let's get back to Netflix. We want to look at pillar at number 5, which is shares outstanding.
What do you think this one's going to be?
Well, they're at a very high price. I would assume, I don't know if they might be typically at a high stock price. We'd be selling off some shares to get some more money in there so we can
Why would they do that? That's a good point.
Build and do other things. Maybe make some not acquisitions, Paul. What
no,
do
you
we
make
do?
acquisitions
with that money.
Or do a bunch of stuff, but
invest in yourself.
And Seth is right. So when companies have high stock prices, they'll issue shares instead of issuing debt because they're going to be like, hey, listen, our stock price is really, really crazy overvalued. Let's just sell at 65 times earnings. If the company will stabilize at 20 times earnings, they're basically issuing shares and saying we're only spending a third of our dollars because this company should be for 15 or 20 times earnings, et cetera. And their shares are going up, 430 to 443. Not as much as I thought it would be, but it is going up. However, 10 years ago, it was 388 million shares. So they're up a lot over the last 10 years. So that's an X as well.
How about pillar number 6 is current assets over current liabilities?
10 billion in current assets, 8 billion in current liabilities. That's a check mark.
Nice. Free cash flow growth. This is pillar number 7, the granddaddy of them all. We love this, Paul. I'm sure their free cash flow is incredible, eh?
Well, let's see. I added this line to the investing section of the cash flow statement because it was always hard for people to go, wait, how do I calculate this? It's cash from operations less your capital expenditures.
Look at this, Paul.
Negative 1.8 billion to a positive 2.5. Last year was one of their only years of free cash flow in the last 10 years. So we have an average of negative 1.35. So it's a check on the growth. It's an X on the multiple because multiplying 20 times a negative 1.35 is not doable. The company's market cap is what? What did we say it was?
240 bill.
So right now it's selling for 100 times free cash flow of last year.
That's a lot.
Well, let me ask you a question. If I were to tell you, hey, buy this company, and again, there's a lot of growth available in this company still.
Still? That's my next question, Mo. Have we missed the boat on Netflix? Is it already too high?
They have? So this is part of your analysis going further. How many active users do they have? How many paying monthly users they have? And here's why. This is part of every investment. What do you have, Seth?
208 million as of April 19th of this year.
Yeah, I see that over here.
Okay,
too, so. 208
million, guys. So you have to ask yourself, there's 7.5 billion people in this world. Are they going to be the leading provider of streaming data, streaming services for a long time? I think they will. Tim's over there, shaking his head.
And yesterday they announced that they're coming out with video games on their platform, and they're not increasing prices. That's what they've said.
Wow.
And they brought in a former bigwig at Facebook. He worked at Facebook and Electronic Arts, so they're really going for it here.
So 208 million, you're getting they're becoming like the companies that like Amazon did.
Yeah.
We want to make sure people only come to Netflix. They do everything now.
Yep.
Is there a lot of streaming competition now?
Of course.
Absolutely. That is an issue you have to discuss yourself. Like, okay, is streaming going to become like the new cable, where you just have 10 streaming services, you pay a total of $120, $130 a month, but you get thousands and thousands to show all this content? Will there be consolidation? I imagine next 10 years there'll be consolidation either through people stopping the money losses and saying, listen, but a company like Disney, they can afford losses along the way because they're like, listen, we already have so much cash, so we have so much profit. We're okay losing $1 billion or $2 billion a year. I'm not saying they do, but these are the things you have to consider.
A company like Google, same.
Yeah.
With YouTube.
Yeah. So you have to sit there and think to yourself, okay.
Would you consider, Paul, contemplating growth for the future, Netflix hasn't even started making multi-million, $100 million movies,
Right,
action movies. I mean, when are they going to sign The Rock to a 6-movie deal? Like
Well, they do
did
that
with,
now.
Well, they do, but I would argue, I think I'm with Seth here. Their studio is pretty small for what they could be.
I mean, they're doing stupid
they
Adam
don't have
Sandler
they don't have any
videos.
crazy blockbuster movies yet.
Yeah, but they paid Dave Chappelle $60 million for 3 shows, 2 of which were already created.
Right. But I think it's going to get even bigger. Like they're going to
I guess
come
that's
in
the
and grab
point.
like The
Yeah,
Rock.
I mean, when are they going to grab
course.
The Rock? They
Studio,
grab
but-
some top folks.
Yeah.
Not denying that at all.
Yeah. It's going to be pretty good.
So I agree with you.
Yeah.
I think Netflix is the streaming service.
When you
I don't
think
think there's any doubt about that
Yeah.
one. We all agree?
When you think streaming, you think Netflix.
Yeah, like even Amazon Prime, I kind of look at, whenever somebody says Amazon
Lord,
Prime,
help
I
me.
go,
It's
come
bad.
on, give me
Have
a
you
break.
tried to watch anything on Amazon Prime?
it's
It's so
bad.
pointless.
It is.
And they charge you, every single thing is like, hey, it's Amazon Prime, you get it for free, you get free streaming, and then you go to it, it's
Plus
like, well, yeah, this
$3.99.
video is $4 to rent. This one's like, I'm like, come on.
Has Netflix created a moat, Paul, that you can't get into?
Well, I think that's been proven already in the last few months that that moat doesn't exist. The other thing is, guys, remember, Netflix, unless they make their own content, look at The Office. Wasn't The Office on Netflix?
It was.
What did NBC do?
They moved it to Peacock.
They created Peacock. They moved it to Peacock.
Yep.
Seinfeld. These things are going to happen. So it's going to go from what it was before, which is let's go partner with these other networks, to they're going to become their own network, right?
Yeah.
Like you guys are saying. I love the shows that Netflix makes, right?
Yeah.
I love the fact that, I was watching Entourage, right? I remember thinking to myself, like, my God, remember when you have to sit there and wait every week for that cliffhanger? It's like,
Yeah.
oh my God, what is this? And you have to wait a week, and then it's like, now it's just next show. You know what I mean? I love that. It's becoming a network, essentially. At the end of the day, it's just becoming a network. So you have to ask yourself, what is that network worth at some point?
As a value investor, before we get to Mo and trading this, it doesn't sound like this is a screaming enough deal for someone like you, where the mindset should be not so much how much money can we make, but how much can we lose. It seems like this is a little all over the place.
Well, we're going to put it a stock analyzer tool. And one of the things I'm going to say, though, initially is everybody in the world loves Netflix, so therefore everybody in the world loves their stock. Their stock has flown up a lot. They're selling for 65 times earnings. Just my contrarian viewpoints will sit there and say it's probably overpriced.
I'm excited to see what you put into the stock analyzer tool.
The
That's what
assumptions
your
I make?
assumptions. Yeah, I'm excited to see.
Okay,
your
let's go to,
assumptions.
what's your name?
His name is Mo. If you're in the
I literally started
Patreon,
saying Seth Tim Mo.
if you're in the Bid-Ass Nation, the Patreon, and you love trading stocks, whether it's momentum day trading, we're gonna head over to the handsome Mo, and he's gonna show us these charts. Mo, what's going on with Netflix, baby?
So this is a year chart on Netflix, and if you can just draw consolidation lines right across, and it's kind of stuck in this range of, I should have drawn that a little $500 to $600, and just keeps bouncing back and forth in there. So there's really no movement on the stock. I mean, $100 is big, but let's also look at these gaps, because earnings are coming out on 7/20. So there's a lot of gaps in here that happen, and these tend to be on earnings. So Netflix moves big when it comes to earnings. So please be careful of that when you're working on it. Now, this gap right here has filled, but this little tiny gap has not filled. So I do think that eventually this is going to come back here, find some support at $530 a share, and then you'll be able to make a nice run to the top. But as of right now, this is getting into some area where I'm actually losing a lot of confidence. I think the stock is losing steam at this price. The only reason it got this bump today was that news that came out about the video game service. So just be careful with this one. If you want to play it, or if you're in it, please keep your stops in place, keep them pretty tight, and take your profits away if you have them.
If you're watching this later, today is July the 15th.
Thank you.
You know why I say July? Because I was just in South Carolina.
Yeah.
And in Ohio, we just say July. But
Yeah,
they say
down
July.
there they say July.
So this is July the 15th. And make sure you follow that thumbs up. Paul, what are you doing on that stock analyzer tool?
All right, so this was going to be a hard one, and I want you to remember, everything's based on assumptions you put in. The stock analyzer tool is part of our software. There's a video here that'll explain you how to use it. Everything's about the assumptions. We're going to change the assumptions a couple times, and I'll just show you what I'm putting in here. I already saw the analysis. I'm actually surprised about how high the analysis made the stock. So this is the 1, 5, and 10-year growth numbers. It's still lower, which makes sense. As time goes on, it should be lower. I went conservative and said 10%, 12.5%, and 15% revenue growth. This is the thing we're going to change after we hit the analyze button. We'll sit there and change it even higher. Share change, I put in 2%, 1%, 0. Profit margin, I put 8, 12, 15. And the reason I went high on 15 was their high gross margin of 41%. I think as time goes on, it'll drive that profit margin higher. Now, also keep in mind, though, as profit margin goes up, competition goes up. So unless they have that moat that's insurmountable, which I don't think this industry has that, then you have to figure that out. Free cash flow as a percentage of revenue, I did the same thing, 8, 12, 15. PE, I put 15, 20, 25, 15, 20, 25 for a free cash flow multiple. Desired return, 15, 12 and a half, 10. Let me stop everybody before you start blasting me on the messages. Paul, 15 PE, 20 PE, 25, it's at 65. A deal would be 40. No. Guys, I'm sorry. If you look at history, even expensive companies end up coming back to normal. You've never ever seen, I don't even remember a company that over a 30 or 40 year period has an average PE that is very, very high. If you look at the history of stocks, you guys are living in a time right now where stocks are so expensive that you think 25 PE is cheap. Even I think that. I look at a stock as 25 PE. I'm like, no, it's not bad. I'm like, no, Paul.
Oh, me, Kevin thinks 90 is
So he thinks 70 for Tesla 10 years from now.
Okay, go on.
Which is why me, Kevin, will lose a lot of money in the next few years on Tesla stock. Yes. So anyhow, I will be nice. You hit the analyze button. It goes forward. Boom. All right. We have a low price of 71, a high price of 380. All right. So 550 to 380, not that bad. But guys, again, the stock analyzer tool is used as either I've done my research. I know my exact numbers I want to do. Here's how much it's worth. Or it can be used before you do your research to say, hey, is this even in the ballpark? According to this, we're not even in the ballpark. Okay.
This stock was $260 in September of 2019.
Okay. Okay. Not bad. So let's change our assumptions. 15, 20, and 25. See, so 17.5% growth and 20. Now, let's keep in mind this. 15% revenue growth for the next 7 years. What are they at right now? How much revenue? 23 billion. So that would take them to $61 billion in revenue 7 years from now. Okay. Yeah. Not unreasonable.
No, it's not.
But 20% revenue growth over the next 7 years would take them to 82 billion. Okay. Now, here's the difference. That means they need about 500 million subscribers with increases every year. I don't know if that's right or wrong. This is the thing about stock analyzer tool, about value investing, any investing. It's all about the assumptions you're making for the future. We don't know the future. The future is unknown. All I say as an investor is when times are really good, like they are now, people's assumptions about the future tend to be rosier. I just read an article recently where the average investor thinks we're going to get 17% returns a year for the next 10 years.
Yikes.
Yep,
That's almost higher than 2000 in the tech bubble when they expected 18% when it was an insane time. And then if you go look at times when I remember in 03 having a conversation with somebody I just graduated from college from, this is after the crash, and they said, well, you can only expect 3 to 5% returns in stocks over long periods of time. Why? Because they just experienced a big drawdown. By the way, keep in mind, I learned something from my sickness the other day.
Go on.
I'm sitting there in bed, I'm sitting on my couch, freezing my arse off. I asked my brother to come over. He's sitting there with a t-shirt on. I go, how are you not freezing? Literally, I'm experiencing this frozen, and he was just like, this is fine. But because I was experiencing the freezing, and I remember thinking to myself, this is like investing. When times are really good, it's really, really difficult to even look and understand how times could be bad. When times are really bad, it's really, really difficult to understand how times could be good again. I was literally sitting there. 2 hours earlier, I was fine. 2 hours later, I'm freezing. I'm like literally covered. I literally couldn't even put my head above the blanket because it was getting me so cold. And I was literally looking at people as they were FaceTiming me going, how are you guys comfortable right now?
Yeah, you're a pansy. Okay, keep going.
The same thing occurs with investing. You have to sit there and realize that when times are good, wait a second, what'd you say? When times are good, it's hard to see bad times, but this could happen. So anyhow, let's change our multiple because you're all going to say, Paul, you're crazy. The multiple's too low. So let's see what it changes the numbers to. I changed the numbers big time on revenue growth and multiple, and it's still barely a good buy on that best possible situation. 20% revenue growth. They don't sell any more shares. They have a profit margin of 15%, which they haven't had in the last 10 years. They have a free cash flow percentage of 15%, which they haven't even come close in the last 10 years. Their PE is 30, which is only half what it is today. You pay a price of free cash flow of 30, and you only want a 10% return. This is what I'm saying about value investing. Is this possible? Absolutely.
Probable?
Is this probable?
Yet.
There's not. remember, guys, good investing is about protecting your downside risk. If all your assumptions are based on the highest levels, I think you're going to have a hard time. And in this situation, I went and did this, and it's just, and even then, it's barely a good buy. By 7%, by 6%, I don't know. If you are comfortable with that, by all means, it's just math. All it is math. Every investment is the present value of all future cash flow. That's it. So if you're going to calculate the future earnings and cash flow using this, and by the way, remember, my assumptions here are stuff they've never hit before. That's what I'm sitting there saying. These two assumptions are things they haven't hit before.
Profit margin, free cash flow.
And you see their revenue growth is decreasing as time goes on. I don't know, guys. To me, it's a pass. But is Netflix a company I'm paying attention to? Absolutely. There's things I want to change. But at some point, Netflix will stop growing so much and people will hate it and they'll start dumping the stock and the PE will plummet. The price of free cash flow will plummet as the revenue is still going up and as the profit's going up. I've seen it 1,000 times.
As I keep learning on this show, as I sort of represent you, the viewer, is becoming a value investor and being more disciplined. I guess I'm getting out of the mindset of what am I buying today versus what is the world teasing in front of me and I need to avoid because I want to find a deal. This is not currently a deal. That's a really good way of putting it. Yeah, and so this is my mindset, Paul. It's not what I'm buying, but what are we avoiding today? What is the world going to tease me with? What trending topic is my uncle going to tell me I need to buy? And I need to slow down and say, nope, I need to get this company cheap. And certainly it's not cheap today. So,
by the way, you don't even need it cheap. To make good money in investing, you don't need to be a deep value investor that buys $1.50. If you can figure out a way to always buy $1 for 80, 85 cents, you will still do better than everyone else.
You're right, Paul.
It's about being disciplined, though. And being okay saying, I know Netflix chart is showing that it can't lose, but at some point, you got to realize that the good times don't last forever and bad times don't last forever. Unfortunately, we've been in amazing times for the last 12 years, which is unprecedented in the history of our stock market. Is that likely to continue? Unless it's different this time, which every great investor of all time says those are the 4 most dangerous words in investing. I don't know. I'm just follow our Patreon if you like this, because there's a lot of like-minded people. You'll hear from me and Mo and Seth daily, new videos that are exclusive only content, 80 cents a day. That's the best value play you have here.
That's our take on Netflix. Thanks for joining us. Fondle the thumbs up on the way out. For Mo, for Paul, we appreciate you watching, and I will see you on the Discord, the patrons. You know I love you. Talk to you guys.